At the end of every day, look at yourself in the mirror and ask, did I get better today? Monday, get better. Tuesday, get better. Wednesday, get better. If you do that for 5 years, 10 years, 15 years, how much better will you be? Are you getting better every single day? That's the real question. And it all comes down to taking small steps. You don't have to accomplish everything in one day or even 1 week. Just focus on getting a little better every single day.
And welcome back to another episode of Real Estate AF, where the AF stands for And Finance. And I'm your host, Mark Jones, and we are powered by LoanBot, smarter mortgage matching. And guys, the last discussion that we had on here was not necessarily heated, but it was very real. So much so that it got demonetized. The topic of discussion was discussing about the 97% of realtors that close less than 4 transactions within a year. And we went in depth with 3 individual brokers that own their own shops, do a great job here in San Antonio locally. And I wanted to bring more to the conversation that has to do with the 97%, but more so what's actually going on in our industry to capture maybe more leverage, more income, more revenue that kind of walks the line of our fiduciary responsibilities. So I'm bringing on a gentleman that I've had on here plenty of times, and every time that I do, I enjoy our conversations because he comes prepared with receipts. So without further ado, let me introduce John Hudson. John, how are you?
Man, Mark, it's awesome to be back.
Pull that mic closer.
Awesome to be back. I feel like it should be reigning champion. So.
Amen. Yes. At this point, it's almost co-host.
Right. There you go. I don't know. It's good to be back. You know, I'm well, just like you, passionate about what we do, passionate about helping consumers, helping our referral partners, and just educating the masses out there. So,
amen to that.
Yes.
So real quick, before we get started, we do have plenty of new subscribers that are jumping on, and they may or may not know who you are. So just a moment to tell us who you are.
Sure thing. And congratulations, by the way.
Thank you.
It's awesome to see all these milestones.
It's
going
like,
up,
what the heck is going on?
No, beautiful. So I'm John Hudson, a local independent mortgage broker here in San Antonio. Mortgage geek, I would say. I've been doing, like you've been doing this a very long time. I've now been in the business for close to 29 years.
Holy cow.
Yeah. So
wow.
This January will be 29 years.
And still looks like he's like 25. How? I have no idea. He's probably half black or something. That'll get demonetized. There we go, Mark.
My grandmother was Dutch.
There we go. That's awesome. So our discussion today, there was, matter of fact, if you could, Alyssa, just throw up the reference view real quick, just so I can show this little piece here. I prompted something back July 21st that said, what are you guys' thoughts on realtors getting their LO license to get paid off of referrals as an LO? And is this a new way of business, or is it straight up a violation of RESPA? And for those that don't know, I can bring up the RESPA thing, but we're going to talk about that. We're going to get in depth on all of it. And again, John is somebody that I trust to give us the real deal on not only perspective, but also opinions and facts.
Definitely a hot sports opinion. But at the same time, too, when I saw this post, I was like, bro, I've got a ton of content that we could go over on and do a whole show on this topic, because it is important for people to know the difference too. What is going on and why?
Absolutely.
You know, and at the same time, dude, there's some remedies that I think we could touch on today.
Most definitely.
That might help even eliminate the need for people to even go this route. So,
absolutely. Yeah. And I did not, but I'm going to, let's see here. Let's go ChatGPT and let's see if it can give it to me in a short. Can you provide me with a short RESPA explanation of the topic for today, which is realtors getting their MLO license? Boom. Let's see what it brings up here.
You know, it's funny. I do always like how the AI doesn't mess with my, doesn't make fun of me for mistyping and spelling.
Yeah. Matter of fact, for a long period of time, I would not submit anything misspelled because I didn't want to think I was dumb.
Yeah.
And now I'm like, whatever. You know I'm smart.
Yep.
Ish. Ish. I'll keep it short enough to read on air. I love it.
There you go.
Okay, here we go. RESPA does not prohibit realtors from also holding an MLO license or earning compensation in both roles. The critical issue is what they are being paid for. Okay, and I want us to focus on that eventually. A mortgage company cannot pay a realtor simply for referring their buyer. To legally receive MLO compensation, the realtor must perform real, necessary, and distinct loan origination services such as taking the application, discussing loan options, collecting documents, and helping manage the financing process. Simply obtaining your MLO license, handling the borrowers to someone else, and collecting a commission could be viewed as a disguised referral fee or kickback. The easy way to remember it is license. The license does not make the referral compensatable. The actual mortgage work does. And we talked about that beforehand, but let's open it up. You can kill the reference. What are your thoughts on this? Just overview.
Well, I mean, first of all, right, so from a consumer perspective, I kind of equate it to when you're buying a car, and you go to a dealership, and you got a sales guy that's walking you around to help you find the right car, and then you decide to find the right car, and hey, this is the one, and then they say, well, great, let's go sit in the financing office, and then they just sit on the other side of the table there for you, and then you realize that they're going to also get a bonus based on helping you buy the car.
That's right.
I think it just creates conflict to the consumer.
Yes. Yeah.
That in and of itself. But, there's distinguishing that's pointed out there, right? And that is, okay, are you actually doing the work or is this just a W-2 with a kickback?
Right.
And that's a big thing that I think needs to be distinguished and talked about there.
Absolutely. And I'll add a little humor to this. What he's talking about is I'm the guy selling you the car. And then I go, okay, let me introduce you to the finance guy. And then they go,
right.
Hi, I'm the finance guy.
That's exactly right. So it's are you really doing what you should be doing for the consumer?
Right.
When in actuality, it's more along the lines of how do I make more money on this transaction?
Yes.
Versus making sure you're getting the best deal.
Right.
And it's sad because I think about the consumer experience about this whole thing. And now I'm not saying that there aren't people doing it the right way.
Absolutely.
But I can damn sure guarantee you that a majority of them are doing it the wrong way.
Well, let's start with the concept of why is this becoming a thing? Because in the past, let's say for those that are doing it the right way, you really didn't hear about it much because they were doing it the right way. They are an actual loan officer taking loan officer application, gathering the documents, offering the rate for the term, et cetera, et cetera.
Analyzing a credit report.
Absolutely. Matter of fact, shout out Tracy Radigan. You are one that does a great job at it because not only did I work with you to buy my first home, but you also were a loan officer at the time. And she did a great job. Yeah. But go ahead.
Well, no, I was going to say, and I believe that's super important as to why is this even a topic today,
That's
right? Like real estate professionals, they find the house, they sell the house, they give the borrower their options on the house, and then mortgage company, okay, they prepare the financing, right? So you've got it, separated. Everybody is in their own lane. Well, I think it's important to go back and be like, why is this even a deal now? So in my almost 29-year career now, we're in the year 4 of the toughest cycle of my entire career.
Yeah.
And what we've had now today is I think you've got 4 major forces that have collided.
Okay.
We're in the post-NAR commission settlement era.
Good point.
And not that a whole lot actually transpired from that.
Right.
But the psychology shifted.
1,000%.
Everybody was like, oh, they're coming after my commission.
In addition to the consumer saying, wait a minute, can we go after their commission?
Right. Well, exactly. So you've got the commission margin compression.
Yep.
A term mortgage people are very familiar with. But for agents now, also, where are their lead sources coming from? And they have other lead sources that they're now paying exorbitant amounts for those leads. Zillow Flex, 30%.
Absolutely.
I mean, so you've got agents now that are relying more on third-party lead sources that they have to pay. So I think they're trying to find other revenue streams to
supplement
that, right? You've also got mortgage companies that, well, we used to just solely rely on the realtor.
Correct.
And now that's getting tougher to do.
Absolutely.
So guess what? Well, maybe it's just easier if I just go hire the referrer.
Yes.
So you've got the mortgage companies promoting this activity too. You've also got, well, and this is, largely what's happening today too, is the CFPB, Consumer Financial Protection Bureau. They've been largely defanged.
Yeah.
So there's less fear of retribution for this.
Absolutely.
And I would say,
and you and I talk about it quite often regarding how much people are putting information out on social media without the proper disclosures, no matter what role you play within the transaction.
yes.
That has been going on for quite some time without any repercussions.
Don't even get me started on that, right? I mean, that's a whole nother topic. But it's true. I mean, largely in the current administration, right? It's basically like the cop is off duty, and the cop's been off duty, and there's no telling when that cop is going to come back on duty. So I think it's very easy for people to say, you know what? Let's just stay in this gray area here.
Yeah.
And so people are navigating that, and that's what they're trying to. And then the fourth major force here is it's the economy, stupid.
Yeah.
Plain and simple. So what happened, traditionally in a normal market, you've got 5 million homes being sold per year.
Sure.
Right. I mean, that's just historical, traditional. This is where it's at.
Right.
COVID happened. You got the COVID bump.
Yeah.
All of a sudden, 6 million homes for sale were sold during the COVID periods because mortgage rates dropped to 2 to 3%.
That's right.
And so everybody got into the business and learned what I would say order taking, and then
paper pushing, order taking. That's right.
And called it sales.
Oh, man, that's a good point. Yeah.
But it's not.
Nope.
But people thought it was.
Correct.
So then, right, flash forward a little bit. Okay, the global economy figures out, oh my God, we've created this inflation monster. Everybody panic. Rates jump from 3% to 7%, virtually overnight, right? Over a very fast period.
Fast, yeah.
It broke the housing market because rates were now up here.
Yep.
Home prices were now up here. And
we hit a stall. Boom.
A big stall.
Yep.
And what's interesting, right? So the market never crashed.
No.
Because it froze.
Yeah.
We got frozen there.
And the reason being that we can say that the market never crashed is property values held all the while that time was going on.
They really have.
Yeah.
I mean, it's, granted, you've got pockets where, take Austin. Austin's having some issues, but
well, look what happened with Austin.
But they were the outliers.
They
far as
did it to themselves.
Appreciation. I mean,
absolutely.
San Antonio, for example, it's just steady. I mean, the market's it's just steady.
That's right.
And so then what happened this past year? We got the false front. Remember late February?
Yep.
Man, everybody was getting fired up. Mortgage rates had gotten down on the national level to 6%.
Yep.
I think it maybe touched 5.99 for like a day. And then we started bombing shit.
Correct.
And when we did that, literally the market broke again because then oil prices went up. Well, when oil goes up, inflation goes up. Gas prices, everything costs more. And so now we're back to mortgage rates on a national level of roughly 6.85%.
Correct.
Which is higher now than it was a year ago. So now it's like everybody's back in that thing of, oh, here we go. So now what do I do?
Right.
Now we're back in the doom and gloom. A lot of people were just hanging in there.
Yeah.
For
waiting for something to change.
Refis are going to come back.
Yeah.
Rates are going to come down. Refis are going to come back. Well, the largest wholesaler in the country just gambled very big on refis coming back. It never did.
It didn't happen.
And now their stock's at less than $2. I mean, so
they call it gambling for a reason, guys.
and they suspended their dividend, right?
Right.
So So the bottom line is the economy has gotten tough,
right?
And then last but not least, what's also part of that too is just the sheer number of people in the industry.
Absolutely.
So from mortgage perspective, I mean, I can't speak to national levels, but just here in Texas, pre-COVID, there were 28,000 licensed loan officers in Texas, just licensed. That means independent mortgage bankers like yourself, mortgage brokers like myself. That doesn't include people working at banks or credit unions.
Correct.
COVID happened, that number jumped to 56,000. Even today, it's come down, but we're still hovering around 43.
Right.
So you've got way less transactions and still
Absolutely.
a lot more loan officers. Realtors had it worse.
Yes.
So NAR membership pre-COVID was hovering right around 1 million.
Yep.
Ballooned up to 1.5.
1.5-ish. Yep.
Yeah. So, here today.
And I can throw this.
Yeah.
Go for it, Alyssa. Right here. When we talked about this on the last discussion, and it was a eye-opening thing, but go ahead.
Well, it's not even necessarily the number of transactions that people did. I mean, look at that. 84% did zero.
Yeah.
Okay. I mean, that's challenging, but it's just the overall number of NAR members, 1.365. So yeah, they've shrunk from the COVID peak of 1.5 to 1.365. But even a year ago, year over year, it's still at 1.4 million.
Right.
So you've got, and by the way, we're now in year 4 of around 4 million in existing home sales per year versus 5 in a normal year.
Correct.
So you've got a third more
That's right.
realtors out there and a lot less business
To go around.
than 20% less business. So yeah, there's a lot more forks out there chasing after a smaller pie.
Yeah.
And when you combine all of those factors together, what do you get?
A perfect storm.
A perfect storm. You get, you know what? I mean, let's just say some people get creative.
Correct. And the, I guess, alternative to what they're offering these realtors is the realtor goes and gets a second job, waiting for this to get better.
Right.
Versus digging in deeper and going back to what I call the basics to capture more business, to help others more, etc.
I have that written down in here.
You do?
The fundamentals.
The fundamentals. That's
Yes.
right.
And what's interesting too, right? I mean, if you go back to that, I mean, if you look at, top producers in San Antonio, they're still top producers.
That's right.
They're not even messing with becoming a mortgage loan officer also. So
Facts.
it's if it is, it's less than 1%.
Right.
So when you consider this, what you're seeing now is not top producers, more exploring into these other avenues. It's like, man, but there are some things that you can do to just become a top producer.
Mm-hmm.
So maybe we should focus on some of that.
Maybe.
But again, I want to toss up a couple slides here because I think it's important. And let's pull up slide number 1 if we can.
Yep. Let's go first. Let's go.
Part of my receipts there.
There's number 1.
So this is what I was talking about, right? And you see, if you go back and look at February, February to March in there, so you look, man, we touched 5.99% on a national level, and then look how quickly it jumped back up. So when that happens, again, it stalls. It pushes people out of the home buying market, or because then they're watching the media, they're listening to social media, and everything goes, oh, it's all going to crash.
That's right.
But it's not. Let's go to slide number 2. And this is what I call the mortgage rate lock-in effect.
Okay.
And what this boils down, and look at check these stats out. So this is conventional mortgage loans that are in the Fannie Mae, Freddie Mac pool right now. So, and what they've got is 20% of all mortgage loans outstanding still have a sub 3% mortgage rate. I mean, I know people that are trying not to get divorced just to keep their 2.75% mortgage.
Absolutely.
So, but keep going. 50% of all outstanding mortgages are below 4% rate. 2/3 are under 5%, and 78% are under 6%. So when market rates are above these numbers, it keeps some people from selling their house. And when people aren't selling their house as much, then it creates stagnation.
I'll even take it a step further. It even keeps people that would have in the past refinanced to pull cash out of their home to pay off higher interest debt. Because some psychological thing is saying, no, I've got to keep this low rate. So what about that 20% credit card that I go 20 grand on?
And that could be a whole show too that we should do just for the consumer.
Absolutely.
To show them the mortgage math on that, because that is so true. Because your blended rate, if you add in the 30% credit cards, is more like 10.
Yeah.
But I digress there. And you see the number of mortgages over 6% is growing, but very slowly.
Yeah.
Right. So, and that's just new originations that are out there. Let's go to slide 3 real quick. And I think this is just interesting too to look at, right? So this is, again, from the same data from the Federal Housing Finance Agency. But look at this. Average credit score of outstanding mortgage loans, 742. Average interest rate, 4.4. That's for all loans combined. But probably the two of the bigger kickers for me, because of course you hear all the people talking about, oh, there's going to be a crash. Don't listen to those buttheads on social media, because the average loan to value out there is 45%.
Wow.
Which means that of all the houses that are out there, borrowers have they owe less than half than what their mortgage, what their house is worth.
55% in equity at least, or 54.99.
Right. And then the other reason why these blowhards are full of it is because look at the armshare. It's only 4%.
Yeah.
So when all these guys are like, oh, look, back to 2008, blah, 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 blah. Well, back then you had highly leveraged. Your average loan to value was way higher.
That's right.
And these pools were filled with adjustable rate mortgages.
Exactly.
They're
correct.
not today.
No.
So there will not be a crash. So if anything, we stay in this kind of frozen pattern
Right.
more than anything else. And so that's kind of like how we got to where we're at today.
Yeah.
Desperation to create income.
Yeah, most definitely.
And I don't want to disparage anybody from getting into the industry or bettering themselves in our industry. But, if it's not working for you, maybe it's just not working for you.
Good point. Good point.
Loan officers, realtor, I don't care what you do. If it's not working for you, you got to find something else.
Yeah, most definitely.
So,
And I think that has a lot. The way that I view that concept is from the perspective of the buyer, from the perspective of the customer.
right.
Are they truly getting the best of what you have to offer?
Correct.
If you yourself are not sharpening your tools and your craft to become the best.
100%.
Does that make sense?
Yes. It really, because it is at the end of the day about the customer experience.
That's right.
So you've got to be good at what you're doing if you're going to continue to grow in a referral commission-based business.
Yes. And let's say if I compare this to something the layman understands, lawn care service. I don't know, I'm just pulling something.
Yeah, that's a good one.
Lawn care service that costs $100 every 2 weeks, but they're going to do it to the nines. It looks great, but you can go to this guy and he'll charge you $50. But then his $50 work is going to be $50 work.
Yeah.
If that makes sense.
Race to the bottom.
Absolutely. Yes. Can I get a lower rate? Absolutely you can. Probably from somebody that doesn't know what the heck they're doing, because they have to offer the lower rate to be able to capture your business.
Well, and is the lower rate the best loan?
Good point. I did a whole YouTube video on this. You're on the money.
And I saw some of that and I loved it because it's what is the best one for you?
That's right.
And that's where novices or people just parking a loan officer's license for a referral fee aren't able to do that. Can you pull up the Morty page?
Yeah.
And this is where I think this would be a good example for us to show
Not this one.
to show people kind of what we're talking about too is the recruiting tactics. Because just 2 weeks ago,
This.
I had a
The one you sent me, right?
yes, yeah, it was one of the links.
Say,
But I had a top producing agent here in San Antonio call me and say, "Hey, I got a call from a guy that's asking me if I'd be interested in becoming a loan officer and getting referrals and getting more commissions." And I was like, why do you want to mess with that?
Absolutely. Come on. Where are you? We've got all of that. John, which one is it?
It was the first link that I sent.
Oh, it is a link.
Yes. Yeah. Oh, yeah. It was a link.
Let's see here.
It was a good one.
There it is. Boom.
Oh, I love this. Okay, perfect.
There
Like
we go.
getting dual license as a mortgage loan officer, what realtors should know. And of course, blah, 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 blah. We're licensed in 45 states, but show me the bullet points here. Look at the benefits.
There we go.
Number 1, provide a holistic experience for your clients. Acting as a loan officer allows you to provide an end-to-end service to your clients that you own the entire way through. Okay.
I get it.
I get it. That sounds good. Everybody likes a holistic experience.
One-stop shop.
Bingo, you're in control. But look at number 2, increase commission per transaction. Well, now the little fiduciary question mark pops up.
That's right.
But look at this. By becoming a licensed mortgage loan officer, you can now earn commission from processing and closing mortgage loans for your clients This dual revenue stream allows you to increase your earnings from each client transaction with limited extra effort necessary on your end. So when I see that, I see that's parking a loan officer license somewhere and getting a kickback on a W-2.
I don't see how it can be viewed any other way. To be honest, when I'm hearing and seeing the marketing, because it's surprising the hell out of me how in the open and unscared of the repercussions, it's almost as if they're leading with number 2 being number 1.
They're 100% leading with that.
Right?
I mean, the sales, because if I'm a sales guy, I don't give a shit about anything else. I just see increase my commission.
Wait, what? I don't have to go get a second job?
Dollar bill, ding, ding, ding. but okay, dual revenue stream with limited extra effort necessary. And I just jotted down. I was trying to think. Okay, what is just some quick things that an agent can do to really earn, to do it right and earn a referral? They have to get licensed. I mean, that's the obvious. I mean, 20 hours, all the things. But originate and structure the loan. I mean,
so let's hone in on this real quick, because this limited extra effort necessary, it almost pisses me off a bit, because what it's saying is loan officer, fiduciary responsibility, duties, what it takes to be a loan officer. It's not that hard.
Right. Yes. That's what I'm saying. It's like limited. So it makes it sound like what I do.
So easy a caveman can do it.
Limited extra effort. Yes. I am waiting for the caveman guy to pop up.
Right.
That would be a good, but that's exactly right. So it was just like, okay, originate and structure the loan. Man, you and I do. And we work with a lot of first time home buyers.
Yeah.
We see everything.
Yep.
It's not easy to,
you can kill the reference if you have it on.
Yeah. It's not easy to sit there and go through either a 3-inch tax return.
Absolutely.
Or read people's bank statements and try to identify, well, that payment on there was one thing. Oh gosh, is that a buy now, pay later? Let me go back and see if that's a debt I have to add into my debt to income ratios.
Right.
Ooh, maybe this borrower needs down payment assistance. I mean, so that's just kind of like the structuring piece. Then there's the whole pulling credit. You still got to know what you're reading with the credit report. Run AUS. So, plug all the data in under the loan. Now you've structured it and see if it actually works. Review the disclosures before you submit them.
That's right.
And send them out, because disclosure,
they
better be right, or it's going to, or that commission that you were promised is going to be gone in what's called a cost to cure.
That's right.
Gather documents.
Yep.
That could be challenging for buyers. Working out any underwriting kinks. This stuff always pops up.
Absolutely. I don't care how clean the borrower is, so to speak. There's going to be something.
Yeah, I've got one I'm dealing with right now. It's a FHA new construction that was actually a foreclosure.
Oh, well, there you go.
How do I get the FHA new construction docs?
That's right.
Reviewing the appraisal. I mean,
Matter of fact, I used to do appraisal review classes with realtors, and you would be surprised at how many have never even seen an
the
appraisal.
Actual appraisal.
Yeah.
That's wow. I mean, I believe it though.
Yep.
Because it's never been the agent's lane. So now they have to. And then of course pricing and locking loans.
And you haven't even mentioned knowing the guidelines for each one of these programs that have nuances upon nuances.
Right. So that doesn't sound like limited extra effort necessary. So so if that's not saying that being a mortgage professional is easy, then it's saying, oh, well, come over here, park your license, and we're just going to pay you a referral fee.
That's right.
And that is where you can absolutely get into trouble with regulators. And I know while the Consumer Financial Protection Bureau might be defanged currently, it doesn't mean that state regulators are.
Correct.
We just went through our audit with our state regulator a couple months ago. And one of the things that they were really honing in on was they're looking for unlicensed loan origination activities. So,
and we talk about that quite often.
Right. So it's coming down the pike one way or another. Yeah. It's just, man, why even go down this road?
More money. And let's flip it over to a concept that I've heard over and over. Matter of fact, if I went back to that Facebook post, you'd see multiple agents saying this verbatim. It's better for my client because they're going to get better pricing. They're going to get better this. You don't understand. They're going to get better.
That's a sales pitch.
Absolutely.
They're
Because if you don't know how mortgage pricing works, there's only so much of that pie to go around.
very little.
Absolutely.
That pie is not very big, and especially in today's market. I don't know if you saw the post I made last week where it's like, yeah, the mortgage industry is just now making a profit, but it's coming out to $600 total profit per loan.
That's right. That's right. So where else is there to give?
There's not much.
And the only people that we can actually charge are the customer.
Right.
So I'm trying to battle with, okay, if this is someone's business model, mortgage company, to go out and attract realtors,
Obviously, these guys. Yeah.
absolutely, get them trained up to the point that they can either do loans or fake it enough to appear that they're doing loans for this commission. How is that going to be a better option for your consumer, even though you're disclosing it to them, that they're getting a better price? They're getting a better all-around experience.
Yeah.
I just don't see it.
The math doesn't math. And if that were the case, if they were truly doing it right, why not lead with, we're going to teach you how to underwrite a self-employed borrower.
Mm-hmm.
We're going to make you better.
That's right.
That's not what these guys are saying.
Not
what
at
they're
all.
saying is, dude, come over here. Put your name on a document and
That's right.
we'll make it work. That's not getting the client a better deal.
Yeah.
And like to your point, that pie of revenue per loan is very limited.
Mm-hmm.
So if they're paying you a commission, that means they're also paying somebody else a commission. And if they're paying, and I could guarantee you that other person that's splitting that commission with you, because somebody is,
Yep.
isn't also probably not the best quality originator out there.
And that is simply just simple, basic logic. If someone is willing to take that much less on a transaction, they're either banking on them doing more transactions because they're now getting an influx of referrals from these realtors,
Right.
or they don't believe in their value.
It's the $50 yard maintenance guy.
There you go. That's exactly right.
So so now how is that better for your client? So, because I saw some of those comments in the Facebook thing too, and I wanted to be like facepalm, just all the way through it. And again, I kind of come back to is, so how did we get here, or how do we get out of this?
Good point. Yep.
And okay, so I want to. Can you bring up the picture number 4?
Yep. Let's go.
And I think this is one that I don't think is talked about enough.
Here we go.
So, and I'm just picking on Pulte, and they're publicly traded, so this data is out there. But I'm picking on them here because this is the perfect example. Builders have figured out how to talk to buyers. Their incentive that they're giving to consumers per transaction is 10%. So on a $500,000 loan, $50,000 is going into one thing: getting that borrower a lower monthly payment.
Right.
D.R. Horton's CEO is on record of saying, yeah, it's way better for us as the builder to pay for mortgage incentives versus even cutting our price.
Right.
And it's better for the consumer too.
Absolutely. Because perception is reality in this case.
100%. Well, you think about it, it's it goes back to, it's the economy, stupid, right?
Yeah.
Inflation has kicked everybody's ass.
Yep.
People aren't, I would say they're not rate sensitive, they're payment sensitive.
1,000%.
And so what the builders have done here is they figured out how to talk to buyers emotionally versus logically.
That's right.
And where I see this battle happen all the time is, I think for a large chunk of our real estate mortgage profession, we try to think about talking to the borrower logically. Lowest sales price. And that's why I get all the little Zillow alerts. -5,000, -5,000, -5,000, -5,000, Well, logically, my brain is going, man, I'm going to keep watching it until they hit rock bottom.
That's right.
Emotionally, well, how do I get that payment lower for you?
That's right. That's right.
And so
the builders have a mechanism to be able to do what other mortgage lenders or brokers don't.
In general.
Yep.
But a realtor seller does.
Yeah.
I mean, especially if you think about all that equity that was. Now, I get it. There's a lot of homes in San Antonio that may not have the equity just yet, but there's also a ton of homes that are for sale that do have the equity to get out there and compete. And every home seller today, especially in San Antonio, their top competitor isn't the guy down the street selling his house. It's Pulte.
That's right.
It's Perry. It's D.R. Horton. It's every builder.
Absolutely.
And I have no problem saying it because you know what?
It's the truth.
It is the truth.
Yep.
And builders, ironically enough, now too, are opening the door to allowing outside mortgage lenders to do more things.
That's right.
But they're still giving the incentives.
Yeah.
Why? Because they know it can be used to buy down the rate.
In addition, they've already overcommitted that concept. So you can't then turn around and sell a home. We talked about this on the last discussion, which is the idea of treating it like buying a car.
Yeah.
Walk in like you're paying cash. What is the cash price of this home?
Right.
Because you're going to give $30,000 towards my incentives. Take it right off the price. Wait a minute. We can't do that. Why? Because we just sold your neighbor the house at $50,000 more. That would be horrible.
I've got an appraisal process I got to keep an eye on.
That's exactly right.
Yeah. But consider this in San Antonio.
You can kill the reference if you.
And here's another just fun fact for everybody. So nationally, new home sales are about 13% of the market.
Yeah.
Which is still up compared to many years past or historically. But in San Antonio, if you had to guess, in San Antonio, what is new home sales percentage?
Oof. Oh, gosh. I would say maybe 25%.
Oof.
More?
Good guess. So this is just June's data.
Okay.
So in June, between new and existing homes, 3,479 units sold.
Okay.
I mean, that's a good June.
Absolutely.
Existing homes, 2,347.
Okay.
New homes, 1,132.
It's almost 30 some odd percent.
32 and a half. We'll call it
cow.
33. So 1 out of every homes in San Antonio is new construction.
Wow.
And why? This is where I come back to, Mark. We're puro San Antonio, man.
That's right, baby.
Our median sales price is 300,000. Our median income hasn't moved in 20 years. It's still like 60 grand.
That's right.
So it's a payment issue.
Yes.
It's not a sales price.
No.
And the builders have figured that out. And so
But even still, that's not enough.
Oh, no. It's even still, it's not enough, but it's a huge factor here. So, I mean, think about this, right? It's like for every new home that gets sold, that's a family that didn't even sniff an existing home.
Right.
They bought in on driving down the street, new homes from the 1800s.
Yeah.
So where I'm going with that, and I do have a CE class for this, by the way.
Awesome.
We should talk about that.
Plug it.
It's called Sell Like a Builder.
There you go.
Same thing, just trying to educate agents, because if you could take this, talk to your sellers about this.
That's right.
Don't get caught in this game of
Price.
lower. Compete with the builders, damn it.
That's right.
So again, this data is from Sabor. San Antonio homes in June sold at 93% of their list price.
Okay.
Just come out of the gate and offer, hey, we're going to give $7,000 towards seller concessions,
right?
Or 7%.
That's right.
Swing it. And I bet if you do that, you'll generate more clicks.
Yes.
Than you will than just doing little price cuts.
Well, I mean, why not? And as long as you have the proper disclosures, instead of talking about how beautiful this house is in your description, give a breakdown of what that actual buy down could do for the buyer's payment.
Yes.
And then have your disclaimers and disclosures, but definitely show them. A lot of people need to see it.
And talk to you, talk to me, talk to a licensed mortgage professional.
Most definitely.
And they'll get you the numbers that you could plug in there. Right. The borrowers know it's a 3-2. They're clicking on they're looking at the pictures.
They're going to go see that. You're right.
They know it's got a pretty kitchen.
Absolutely. Yes.
But you got to talk to them emotionally, and builders have figured that out. Mm-hmm. And they're willing to commit 10 cents of every dollar towards getting that buyer to see that payment.
Yeah.
So agents today, don't focus on becoming a loan officer. Focus on that component. And if you learn that, you could sell more. I come back to down payment assistance.
Okay.
You and I also do a lot of down payment assistance. So, and I'm not trying to be doom and gloom for anybody.
No, this is data that people need to know that's not being brought to the forefront of conversations.
It's not, and it's disturbing that it's not.
Absolutely.
Because there are green shoots, I would say, or silver linings on the cloud. And that is like the younger folks.
Yeah.
We know all the middle-aged Gen Xers, they got a 3% mortgage. They're not going to move for a while.
That's right.
Find the young guys.
Mm-hmm.
Look at this. So this is data came out. And so this is from ICE, Intercontinental Exchange.
Yeah.
Basically, they own the largest loan origination software in the country, like 80%. I mean, it's Encompass, 80% of mortgage
They've got
banks.
the market share. They've got it on lock.
It's insane. But anyway, they put out a really cool monthly report, and they share some of their data, what they see happening in the marketplace. So get this. In June, Generation Z
Okay.
just hit 20% of all rate locks, a record. The younger kids are buying. Anecdotally speaking, I mean, I could say this too. I mean, I'm doing a lot more loans for younger kids in their 20s and early 30s that are now wanting to buy houses. And ironically enough, they're not rate sensitive.
No, they're educated. They do their research.
They want down payment assistance.
That's right. They're leveraging what is available to them.
Yeah,
absolutely.
I mean, so, T-Shack, I'll plug our friends over at T-Shack. I mean, 5% today, 5% assistance today. And I can quote this without an APR because it's on there.
We'll throw it on the screen.
Yeah, throw it on the screen.
Throw it on the screen. Keep going.
So anyway, so T-Shack, they're 5% today. Is probably at 7.125. And buyers aren't scared away with that because they're getting 5% in assistance to go towards their down payment and closing cost. Yeah, if you just click that one, go click lenders.
Lenders and rates. Come on.
Lenders.
There's an easier way to get to this. Why?
Oh, no, you had it. Lenders. And today's interest rates. There you go. Left. There you go.
There. Boom. There it is.
Yeah. So today, FHA, scroll down. There we go. 3-year deferred forgivable. Look at that.
There you go.
7.125 on an FHA loan today, getting 5% in assistance.
Yep.
So a third of Gen Z are also first-time home buyers. 27% of all FHA loans out there went to Gen Z. And then this is interesting too. So for Gen Zers, this nationwide, 29% of all loans used their down payment from non-savings sources, meaning gift from mom and dad.
Absolutely.
The bank of mom and dad is always the best.
Yeah.
If you get it. But if you can't get the bank of mom and dad, there's down payment assistance available. So this is where I'm saying, right? I mean, so as a real estate professional, again, don't worry about the loan officer part. Focus on what are things that you can learn mortgage related. Work with your licensed mortgage professional, and hey, learn about builder incentives. Learn about down payment assistance. Actually, I have a CE class for that too, by the way.
I love it. Plug it.
Yeah, T-Shack's down payment assistance. So when you've got 20%, or almost more than almost a third of all millennials and Gen Zers out there using down payment or Gen Z, what does that tell you as a real estate professional? Hey, maybe I should learn some of this stuff.
Yeah.
So
I wanted to hone in on something to kind of tie this to our conversation that we're having.
TDHA, another great product.
Is the idea of if the customer is supposed to be getting the best or better, I should say, with this idea of I'm able to be the realtor and the lender, et cetera, are they not going to be offering DPA? And the reason why I say that, and this is super transparent, guys, any consumer can jump on this website to see it, any realtor, et cetera. SRP.
Yeah.
You're getting paid 2% for the company, not you as the loan officer, in your spread, your margin. So $100,000 property for simple numbers, $2,000. So if I'm splitting that with a realtor that gave me the transaction, how much is there to really split there?
There's not. There's not. No, and you make up a great point. So as an independent mortgage broker, our gross revenue to the company on a down payment assistance loan is 1.5.
Yep.
So we'll call it a $200,000 loan.
Yep.
My company makes $3,000.
That's right.
Before we pay bills,
expenses,
commissions, everything. So it's a smaller pie.
Right.
I feel like Baby Billy. It's like, so why do you do it? Because I'm selfless.
That's right. That's
it. But in reality, but for so many folks though, this is the best way for them to even get into a house.
Absolutely.
And the more younger folks that we could serve, the more they remember, the more they're going to go tell their friends and family.
Yes.
The more we're going to generate referrals, and that's as a loan officer or as a realtor.
Yes.
Right. It's man, we're in the people business.
Yeah.
Make people happy. Give them what they need. Give them the best options available for them. Too many folks still today, and I still blame Dave Ramsey for this.
Yeah.
But a lot of people think they need 20% to put down to buy a house because that's what he preaches.
So many. Yep.
And they're missing out on homeownership.
Yes.
Which for so many folks, because it's hard as shit to save money.
Yes.
So here is an excellent way to do that.
Well, in addition, us as mortgage professionals, our goal, especially for first-time home buyers, is to set them up for success not to set them up for the biggest commission we can possibly
Correct.
make. We utilize this program with good, well intentions, knowing that that customer is probably going to be in that house for, let's say, 3 to 5 years.
Yeah.
Potential to convert it to an investment property, to potential to sell that property, take that money and move it to the next home that they purchase. But if you're not offering this, you're not
Right.
What is the advantage to that customer to come back to you?
Right.
If that makes sense.
And there's some, and there are even still some scary numbers. I mean, I'd be paraphrasing, but it's a vast majority, like 80%.
Yeah.
Of consumers don't use the same agent again
Yeah.
for subsequent transactions.
Yeah.
So, I mean, believe it or not, mortgage companies have a better pull through on
Right.
getting that customer to come back to them than agents do. So, again, it's how do you make yourself memorable?
Yeah.
Help provide them with the best options available.
Yep.
Put them in front of people that can offer the best options available.
That's right.
Yeah, it's funny. Every time I do a closing and they have the mortgage credit certificate,
Yeah.
the realtor's like, what is this MCC? Why have I never heard of it?
Goodness.
Like, because you've been working with the wrong people.
That's right.
So yes, what we've
Or not honing in on your craft, learning those fundamentals, because you got in 2020, 2021 and saw the paychecks and skipped right over what it actually takes to fulfill your fiduciary responsibility.
correct, and so like that's why I have it in here, right? Bringing it home.
Yep.
Agents don't need to be LOs. Shortcuts have ceilings. The fundamentals don't.
That's right. That's well put.
There
is well put.
There you go.
Yeah.
There's your mark that. That's there's your drop. But again, right? It's like, look, getting a dual license
Mhm.
gets you a slice of a transaction you already have.
Yes.
But if you could learn or just hone in on those skills and the fundamentals, you're simply going to get more transactions.
Yes.
And so I was just, doing memory jogging here and just writing some stuff down. So look, if you just added 3 conversations daily,
Okay.
3 meaningful conversations, that's 15 a week. That's 750 in a year. If you were to convert 1 out of 50 of those,
Mhm.
right? So what is that? 2%?
2%. Yeah.
2% rate
That's right.
on 750 conversations. That's 15 more transactions per year.
Yeah.
And I guarantee you 99.99% of the time that a realtor that's doing 15 more units in a year is going to earn a hell of a lot more than they would by doing this
Nickel and diming on
dual licensing loan officer
Absolutely.
thing.
Yeah. So in closing of this, I've got some questions that realtors should be asking before joining any of these mortgage companies, et cetera, just to kind of CYA. Okay.
Yes.
We'll call it CYA. So I'm going to run through a couple of these. What are the exact mortgage duties will I be performing? Who will be the one supervising me? Who handles the compliance of the loans? Who is the person that's going to be completing the loan transaction? What kind of training will I receive?
That's the big one. That's all I was going to throw on that
Yep.
one.
What happens when the loan is transferred? A lot of people don't know that stuff. Can a borrower choose another lender? Will I expect to recommend, will I be expected to recommend the company to every single client? Is my real estate broker approved to even do this? What mortgage companies' compliance departments approve of this kind of transaction? Does the investor permit the dual role? Because there's some overlay, some investors say, no, I don't even want to deal with that loan because there's too much hair on it being dual. There's, whoa, we're paying this many people, this many loan officers. And the idea of referral between intercompany has become a thing, which I'm okay with that. Let's say out of state loan officer, you refer it to another loan officer within your company to get a small portion of commission. Well, at least you're a licensed loan officer. That's what you're doing. And it's within the same ecosystem. Would the arrangement still make sense without my personal leads? And I think that's the biggest one there, because I've seen on some of the comments that say, well, this doesn't work unless the realtor actually has business coming in. Why is that? That's weird.
That really kind of puts it into that. That's what makes it a kickback, for crying out loud.
That's right. That's exactly right.
That's all it is. Because by definition, in that case, you're only bringing that loan into one place, and one place is paying you for bringing that loan in.
That's right. That's right. So in closing, I mean, I personally, and I can tell you guys this, all honesty, I've had 2 realtors that I've hired in the past that were transitioning to becoming loan officer, dual realtor at the same time. Neither one of them worked out. Unfortunately, it was tougher than they thought, because it was not a situation to where you're just going to refer us business and you're going to get a kickback. I don't play that game. And I'll be clear, I am not against realtors getting their mortgage loan officer license. I'm against realtors getting their mortgage loan officer license for the simple fact of getting a referral and or kickback just to refer the deal to the loan officer.
100%. I'm not saying that all arrangements are bad.
Yeah.
Just it's very, I just go back to, it's really very challenging to do both well.
Absolutely. It's challenging to do one of them well.
Right. And especially in today's market, you're going to drive them around to go see 25 houses and then go home to review their tax returns.
Yeah.
I mean, I'm not against doing it, but there's a right way and a wrong way. And those are very good questions. And I think you should absolutely put those questions
in the
on
description,
the description, because those are what agents should ask. And then the other thing too is like, hey, here's one. Is my commission the same on a down payment assistance loan?
There you go. There you go.
And if it varies, you should know right then in and of itself, right, what's going on right there.
That's right.
So no, you've made a great point. Look, I'm not shaming anybody. I'm just saying, man, I just know if you just, again, hone in on the fundamentals, then you could do this. And if it was so awesome and just so easy to do, then every top producing realtor in San Antonio would already have their loan officer license.
You're on the money. You're on the money. And what we've found is that the top producers could care less about this side. They want to do the best for their customer and do their real estate duties to capture more business to help more families.
It grows.
It's right. Yeah. Weird.
Yeah.
So I'll close with this, guys. Having dual license within the state of Texas is not illegal. It's not illegal at all. Texas does allow this, and it does allow you to service both roles. There are advantages, there are disadvantages, but if you are toting that line, and there is a line, be very careful about who you're doing business with and how you're going about doing that business, because what you could end up doing is getting in trouble on this side that then hurts your real estate business both simultaneously. You may have been coached, marketed, sold the idea of making more money by doing this, but in the end, it could affect what got you there in the first place. John, you got anything else to close us out with?
Well, just again, I mean, we're blessed in what we do.
Absolutely.
Serving home buyers, whether it's on the mortgage side or on the real estate side. And I think we should focus more of our energy, positive energy, on that, in truly serving our families, to get them into the right house to meet their needs, to find some of the best options available to meet their needs, and then always stay in touch.
Amen.
And then guess what? Then we're going to get that future referral.
That's right.
And then we're going to get to know their friends and family, and that's going to become a transaction. We're building relationships.
Absolutely.
So let's hone in, focus on that, pick one craft, be awesome at it.
Yeah.
And go from there.
Amen. I love it every single time. Let's see if I can pull this up. Last reference, because I would like to thank those that are continuing to like, subscribe, share with friends. We are now at 65,800 subscribers and growing.
Amazing.
It's just blowing my mind how this is happening. But I have to chalk it up to the conversations that we're having, my guests being transparent and knowledgeable at what we're talking about when the topic comes up. So guys, thank you very much for continuing to listen to our show. We are on all podcast platforms, including Spotify, Apple Podcast. But if you want to see our pretty faces and see our demeanor and over exaggerations, matter of fact, if you were listening on Apple Podcast, you wouldn't have seen me spin around in a chair earlier. But thank you guys for tuning in. And thank you, John, for joining me as always.
Always. Can't wait for the next episode.
Amen.
All right, my friend.
You guys have a good one. And we'll see you on the next one.
At the end of every day,
Peace.
Look at yourself in the mirror and ask, did I get better today? Monday, get better. Tuesday, get better. Wednesday, get better. If you do that for 5 years, 10 years, 15 years, how much better will you be? Are you getting better every single day? That's the real question. And it all comes down to taking small steps. You don't have to accomplish everything in one day or even 1 week. Just focus on getting a little better every single day.